We have so many investors that also, and you could tell they're somewhat new investors too. And I always tell them, before you go and, if you put together, say 50 or $100,000 that you're ready to put into a deal, I always tell them, look, there's always another deal. If you were to invest in anything, though, I would invest in yourself first.
Welcome to the Generations of Wealth podcast. I'm your host, Derek Dombeck, and today we've got a gentleman named Sam Morris, and Sam is down in the great state of Texas, and his story on how he got from kind of working in the banking industry right out of college to now running a very, very large operation in the hundreds of millions of dollars. It's interesting because you know what? As you listen to the show, he's just kind of learned as he went and positioned himself to be in the place of opportunity. And I think there's a lot of lessons from that. Before I bring Sam on, I always try to take a little bit of time here to let you know how much I appreciate you following the show. Anything we can do to help you, whether that's a connection to somebody or something that I can help you with on a deal. If you're looking for money, if you're looking to invest some money, don't know what to do with it, got a deal you don't know how to get closed, anything, just reach out. So, thegenerationsofwealth.com, derekdombeck.com, shoot me an email, derek at globalgow.com, and let me help you. So, that said, let's bring on our guest. And all the way from the Lone Star State of Texas, Mr. Sam Morris. Sam, thanks for being with us on the Generations of Wealth show.
Derek, great to be here, man. Thanks for having me on.
Absolutely. I would really like for you just to tell the audience a little bit about yourself, and I think we're going to just dive into how you started and where you are today.
Yeah. Well, I'll kind of start at the current and then I'll reverse it for you. So I'm a partner at Lone Star Capital. Lone Star Capital is actually based out of New York City, but all of our assets are here in Texas. So we have a little over 5,000 units, multifamily units here. We really specialize in that workforce housing, and we've got about 700 to 750 million AUM, depending on how subjective you want to be with cap rates and things of that nature. But that's kind of where I'm at today, and I oversee our acquisitions, our asset management, and our investor relations side of the business. And so that's kind of what I do from a day-to-day perspective today. So,
When you say we, how big of a team does it take to manage a portfolio that size?
yeah, I want to say there's 163 employees, give or take, right?
Okay.
With where we're at right now. And our corporate staff is housed in New York City, and obviously our on-site teams are at the properties, and they're scattered throughout Texas. And so I get the benefit of getting to be down here, and even like later on today, I'll be going and seeing one of our sites and visiting an investor coming in from out of town, and so it's a little bit of everything goes on. And last night, I had a lot of our operations staff and a couple of our asset managers over to the house because they're obviously down here as well and
Mhm.
reviewing their sites and taking care of operational duties.
So let's go back to the beginning now, because
Sure.
you're working with and running a large operation, but you didn't start there.
No,
Nobody starts there.
no,
So
that's correct.
how did you get started?
Yeah, I actually got started in a pretty advantageous way. So I'm actually from the corporate banking world. And so fresh out of college, I went and started cutting my teeth in small community banks down here in Texas. And so the good part of that, although I didn't think it was good at the time, was all I did all day, every day for years was underwrite deals and all kinds of deals. So not just multifamily deals, but literally all kinds of deals. And they say if it takes 10,000 hours to master a skill, well, I became a master underwriter probably by the time I was 25 years old, because it's literally all I did for days and days and days. Just continually underwriting deals and understanding deal flow and understanding how those how those deals worked. And so at a pretty young age, I had a pretty good understanding of how these deals worked from a financial perspective.
Hmm.
And that was really a great thing to see because by the time I would say I got to my mid to late 20s, really, I started going, wow, this is an opportunity that I wish I probably should be able to get into. And because I was in that banking world, I knew who a lot of the syndicated players were. I really just went and approached them and said, hey, can I invest alongside you in these deals? And a lot of them were willing to do that. And so, um, having kind of that insider knowledge
Hmm.
on the back end of actually getting to see the actual numbers, see how these guys were making money, see how they were actually operating the deals and what they were doing, gave me that confidence to go, you know what, I'm gonna put some of my hard-earned dollars into these deals. And so I actually started in this industry as a passive, not unlike many of our investors we have right now. I had another job, but I had great knowledge of how the deals worked, and it gave me a greater sense of the ability to go ahead and invest in the deals and get over that mental hump of, man, should I really let go of my money and put it into these deals?
Yeah. So all of this takes time, and a lot of people, they want the easy button. They want it today, but it sounds like you were just seeing it, learning it, and embracing it over time. When did the switch happen?
Yeah, so it was kind of funny. The very first deal I did, I always laugh because uh, we had, I think it was Hurricane Ike in Houston. We bought our first deal in Houston, Texas, and it was like in August. And the very next month, hurricane came and just blew the property away. And so, what a learning curve, right? Because in my mind, I'm sitting there going, oh my gosh, did I just lose everything we just put into this deal,
Hmm.
right? And and I say what a learning curve because I quickly was able to figure out then what happens when a property, goes from 100% leased to 12% leased overnight because of damages occurring to the property. How do you deal with insurance companies? What happens in a natural disaster? What are you still required to provide as a landlord to those tenants that you're
Hmm.
contractually obligated to give housing to? I mean, it became just a massive learning curve at that time. And that was back in like 2007 or so. And what I learned from all of that is, man, it's not as glamorous as you would hope. But one of the things that it did, though, was it enabled me to see some of the back end side of that. It was, well, man, you really need to build relationships with contractors and third parties and how you're able to make this all work as an ecosystem and what you do with your operational team that's actually running the property for you, how you handle things with residents and making sure you're taking care of them because they're the ones who ultimately are going to take care of you, making sure you're taking care of your on-site team, who's also one of the ones who's going to be taking care of you. And it started shaping a lot of things in my brain of how this business runs and how you can truly operate. And the fast forward, a handful of months, the beauty of it is what I learned is 10 months later, after we had fixed the property up and pretty much made it brand new, and all of a sudden, our business plan was obviously changed because we made it a lot nicer than what we were probably going to fix it up as. And, insurance enabled us and helped us to do that. And our residents who moved back in were very appreciative of it. And so much so that they were willing to pay us quite a bit more to live there because they got new appliances, new flooring, new cabinets, new everything in their apartment. So it became a much nicer place for them to live. Well, in doing so, and learning cap rates and things of how that worked, we were able to go out and refinance that property. I want to say right at about 11 months and return all the equity back to the investors
Okay.
less than a year in. Now, deals like that were able to be done back in those days. It's much harder to do these days, but
Hmm.
it was something that really was a light bulb moment to me because I was like, wow, all the money I put in, I now have back. We haven't even owned this thing a year, and I still have all my ownership in it. And we're going to start making money on that original ownership. And so it was that light bulb moment of how you can create value through owning deals, how you can operate and actually force appreciation into them and start making a lot of money in it. And so that was kind of that first hit, which was fortunate because a lot of things went not right, but it forced me to learn a lot more things that I didn't have that knowledge base on. And, the growth has been great since then. I constantly learning, constantly growing in this industry. And so I've been doing it for a hot minute, more
Mhm.
so on the asset management side. But it's been a great ride so far, and I love it. I love getting up every day and getting to do this.
So then, that was the beginning, but how did you get into where you're now a part of this huge conglomerate, right? That, Lone Star Capital is today.
Yeah, which is kind of funny because it's never linear, right? And so I had sold my last bank in 2018. So I really learned how to syndicate and raise money, believe it or not, in the banking world.
Okay.
So I tell people I've been raising money since before it was cool. And when you raise money prior to 2012, right, which is when the Jobs Act passed, it was a very different world back then because you truly had to have, I mean, fully SEC compliant relationships. There was no social media you can go jump on and say, I'm raising money for this deal or anything like this. You truly had to have the relationships with people. And so you would raise money. We would raise money. And at that time, it was mainly for the banks. We were capitalizing our banks that we were at. And so I learned that skill set that way too. So it's kind of funny how much the banking world really taught me that translated well into the real estate world. And so when we sold my last bank in 18, I went into real estate full time. I was already doing some asset management for another group that I was co-GPing deals with. And I then went full time into it and became the chief financial officer and chief investment officer for another group. That went well. We did about 4,000 units here at Houston. And then at that point, I branched off and started my own company. We did really well for about 3 years, and we merged our company this year with Lone Star. And so it's been one of those things where it became it's a good marriage for us because it gave us a lot more human capital and allows us to scale. We really needed to be at a position of scale to do well. And so that's the precipice of how I kind of got to Lone Star, right? We did a merger this year, and so that was about 6 months ago. And so it's been a great marriage so far.
Yeah.
So.
So what's the future look like? I mean, just for Lone Star in general, but then after that, I'll kind of ask you what you think the future looks like for the markets and all things real estate.
Yeah, if I'm crystal balling the future from the market as a whole, I would say we've definitely had some headwinds the last couple of years. A lot of operators, a lot of their challenge has been structure, the way they've structured the deals. And that goes into play with, say, interest rates. It goes into play with maybe supply and things of that nature. And so the guys who win in this kind of environment, because I was making comments the other day, I said, this year, 2025 kind of really feels more like 2010 to me, which
Mhm.
I know that precedes a lot of people even in our company. And so, as far as their ability to be in the business, and what I meant by that was, man, it was kind of a scarier time during that time frame, in particular when we were buying deals, because it was just there were a lot of uncertainties and unknowns. But you fast forward 2, 3 years later, in that 2012, 2013, it really was like, oh my, we're looking back going, why didn't we buy everything we could at that time, right?
Mhm.
Um, and it has that kind of feel to it. It's not the same kind of environment, but what really got a lot of people through that was their ability to operate. And so you had people that were operators, fully vertically integrated, who were able to make pivots and turns and be very nimble. And they were able to actually grind through and win in that environment. And I actually think that's going to be kind of like what these days feel like right now, that those that have the ability to have full control of their asset and go, you know what, we need to make this decision. It's going to be the best decision for the investors. Let's pivot here or change here or adjust the business plan for this. And they make those decisions fast and they're able to actually get ahead of it. You're going to out operate that person who's running it with, say, a larger third party manager, or just doesn't have the expertise to be able to do that, or the skill sets to do that. And so I actually think being the operator in this environment is something that kind of head and shoulders puts you above others because of your ability to be nimble and to make those changes and to make decisions that are in the best interest of the investors.
Yeah, I agree. And going through the downturn, like I started in 2003 and got my butt kicked in '07 through 2010. And then on that rebuild from, I was that guy who I couldn't go and buy up everything I wanted to. I mean, I was buying, but I didn't have the ability to do it. And it sucked sitting on the sidelines because I knew, I mean, I could see it, but couldn't do anything about it. And I've been looking forward to market shifts for years. I've been saying for 5 years, it's coming, it's coming. And that's when you weed out the weak and the cream rises to the top.
Yep.
And you know, it's great for a small percentage and it's terrible for everyone else. But that's literally why we have market cycles, why we need market cycles. Otherwise, if it was all great all the time, well, hyperinflation would destroy the world, right?
Sure. But
So,
it's also the ability to see those opportunities, right?
yes.
And to be opportunistic when it happens, right? And sit there and go, look, and just call a spade a spade. Your loss is my gain in this particular
Mhm.
scenario, and I'm going to be able to do it and operate it better than you. And so, we have um, a deal that we're looking at right now, and the seller has to sell, right? And it's the best kind of distress because they have a loan distress. They literally have a maturity coming up, and they're going to have to sell the deal. And they use third-party management, and there's some efficiencies that they're losing there and things that they're not taking advantage of. And you can see it as an operator really clearly and go, my gosh, like why wouldn't you do X, Y, and Z? Like in this submarket, this is exactly what you need to do, right? And having that local knowledge obviously helps with that. But you just sit there and go, man, these guys got invited to a gunfight and they brought a knife, right?
But
they're not going to win.
But that's the same thing in every, area of investing, right? Like if it's house flippers, landlords, syndicators, the newer people come on, the inexperienced people come on when the markets are going bananas and they can't hardly screw up while the market is that way. But again, all of that stuff comes very clear when the market shifts.
Yeah.
And so I look at it I'm primarily in residential real estate and houses and not in the apartment complex space, but it's very similar. Right now we're seeing average days on market in the Midwest are starting to extend, and the Midwest is stable compared to many parts of the country, most cases. And same thing, the people that are trying to sell their properties, they're panicking because they're not selling as quick. They're still selling, faster than a bad market for sure. But right, we all see this. Any of us that have been in this business for, I would say, 10 plus years, at least have been through some form of a cycle. And those of us that have been in 20 plus years have been through a couple cycles. And man, the clarity from being through those cycles, and you already know the end of the movie. You know how it
Yeah.
comes out to a certain degree, and it's
Yeah.
really great,
Yeah. But as you said too, you earned those battle scars,
Oh
right?
yeah, yeah.
Uh, and so you'll have earned those battle scars too. You can go, look, you raise your hand, guys. We don't want to do this. Trust me. Let me
And you
let me
can't
show
read
you the scar from it.
you can't read it in a book. You can't be told. I
Yeah,
mean, most people, everyone says I'm going to learn from other people's mistakes, and yes, you learn some things from other people's mistakes. But by God, I could tell somebody, please don't do that. I've lived it, been there, done that, got the t-shirt, got my ass kicked. Please don't do it. And they're like, oh, yeah, it'll never happen to me. And then it happens to them, right? Like, that's just human nature.
yeah. I would say for us, and in particular, I would say this year, this became a lot more prevalent, which was um,
The best negotiators don't just respond to objections, they dismantle them before they ever come up. Inside Elite Negotiations Academy, you'll learn how to spot concerns early, Address them with confidence and keep conversations moving toward a yes without pressure or games. We walk through real negotiations, real objections, and real outcomes, so you know exactly what to say and why it works. It's not about slick sales tactics. It's about understanding people, earning trust, and leading the conversation. Join now for just $49 per month for your first 3 months at elitenegotiationsacademy.com. Because the best way to overcome objections is to never give them a chance to grow.
We deal with not just with a lot of investors, like individual investors, but we also deal with fund managers, and it was really there's been a lot of training of understanding you know, the risk reward metric and
Hmm.
understanding, look, if you want to make X, those deals probably are out there. You'll find them on a pro forma basis. Whether or not they can actually be achieved is another story, but the amount of risk you're taking associated with that, you're starting to see some of the ramifications with how some of the people are losing money today, right? And entire losses in deals, whether it be from forced sales or foreclosures or just where they are in the market, they're losing the deals. And so when you start seeing deals get presented where they actually can get done and there's some certainty to those deals, which I harp to use that word, right? But they're using lower leverage and they're performing lower returns and larger exit caps and things of that nature. And you start going, look, that feels a little bit more conservative and realistic from an underwriting standpoint. And you'll have people pop back and go, well, hold on, I can't get my, you know, X return, whatever it is, and you go, well, how's that working out for you so far, right? With what you did, like this, you want something that's a little bit more certain, it has a lot more downside protection to it, or do you want that high flyer where you could lose it all? And so
Hmm.
you start to figure out the investment thesis of a lot of these investors and fund managers real quick. And I think a lot of them are trying to figure it out for themselves. And so we've been doing a lot of education, I would say, the last 6 months for sure, of just kind of going, hey, understand what you're actually looking for, make sure it aligns with who you're investing with, um, and then you go from there, right? So, I mean, when there's a deal, I always tell people there's four things that you got to go to before you pull a trigger, and the deal itself is literally the last thing you look at, right? The first thing you look at is um, the investment thesis, right? Because if I say, hey, I want to invest in single family homes in Florida, well, the Midwest, Derek, you're not my guy, right? I
Yeah.
mean, if I said I wanted to do Midwest, you'd be my guy, right? But if somebody came to me and said, "Hey, I want to invest in single family homes in the Midwest," I'd have to go, "Well, that's not me, guys. That's Derek. Go
Right.
talk to him."
Right.
Because I do multifamily in the state of Texas, and so it gets really specific to go figure out what you want, what your investment thesis is. That's number one, and number two would be the sponsor. All right, from there go figure out who's doing all these things. Figure out who you align with. Figure out, are they the type of person you want to be putting money with? Are they the type of person you want to have a business relationship for multiple years? Because these things don't just trade, they're illiquid, right? It's
Right.
not like I can buy today and sell tomorrow like a stock, right? You're going to be in business with this person for a long time. And is this somebody that you can do that with? So that would be number two, right?
Hmm.
And then from there, you got to look at the structure of how they put together deals, right? Is this somebody who charges a lot of fees up front? Are they heavily aligned with you and are going to make sure if you make money, they make money, right? And vice versa. Or is it, hey, they make a lot of money no matter what? That's how they put the structure together. And there may be less incentive for them on the back end. Well, understanding these things, before you ever even look at the deal are kind of critical. And I think more and more people are now starting to realize that. And that's why I say the fourth thing, the very last thing is the deal itself, right? And then go see, does this deal, does this fit the box? I found the people, I found the structure. Does the deal fit the box for the risk I want to take, right? And so a lot of what we've been doing the last year is kind of trying to educate, our investors and our fund managers about that type of understanding because you know they're in it with us, but it's also understanding like, hey, we want to we want to preserve your money first and then grow it, right? We want to know that we got it here and that it's going to be able to grow from where we're at.
So what do you think is going to happen in the multifamily space 2025, 2026? And before you answer, again, it's not my expertise or my space. I interview and talk to many people in that space. For me, I'm not an institutional funding kind of guy. I'm a private money guy. So I've saw a lot of these syndications as they were put together the last few years that they just screamed failure because of the way they were structured. And syndication is typically subordinate to institutional funding, not always, but typically. And, I see a lot of people losing money, which is, the syndications themselves. Um, and of course, those people are going to be very jaded about investing in real estate again, most likely. Uh, but that really looks like a lot of opportunity for operators like yourself. That's what I see. Tell me where you're at.
Yeah, and so I mean, I can probably even add a little bit more technical to that. So, from a broad base, I would overall agree, and you're already seeing that. You're already seeing operators that are, or syndicators that are, I would say, being forced to leave.
Hmm.
Probably the easiest way to say that. And they're taking down a lot of people with them, and it's gonna, yeah, it'll sour some grapes out there for sure. But what we see, at least locally here in Texas, because Texas is it's a unique animal of itself, right?
Hmm.
And you really got to have boots on the ground down here to really understand the market, right? And so, just like there's not many markets I can go outside of Texas where we wouldn't have knowledge gap. Um, and what that means is like I couldn't go to Minnesota and go buy, you know, multifamily real estate. I just don't know the market that well. And it wouldn't be wise for me to do that unless I had, somebody on the team that had great knowledge of the area and the city that we'd be looking to acquire in. But we do know Texas really well. And so one of the great things about Texas and how resilient it is it's still heavy attraction for in-migration. And so we still have a lot of people moving here every single day.
Right.
And a big reason for that is we're still creating jobs. So we still create, when you have jobs, people move there for it. That's a natural thing that occurs. We had massive supply that we've been chewing through. And now that imbalance is actually flipped the other way to where you're actually starting to see more demand than units that are being brought on. And so when you see that, you'll start to see organic rent growth. And it's specifically a little stronger in Houston and Dallas, less stronger in San Antonio and Austin for sure. Um, but you are starting to see them start to chew through this immense supply that was brought on I would call it really the last 2 years. And as we get through the rest of this year, the amount of new supply coming on has fallen off a cliff. It's not even back to historic norms. It's well below that. And so I see that will have to turn around and tick back up because the demand will require it.
What
Uh,
what dropped that supply? Was it just cost of building got out of hand?
Yes. Interest rates, there was a perceived oversupply. Merchant builders weren't able to move properties as fast, and so it was shut it down. That and we had a lot of logistics things going on. You couple that with even the new tariffs that are coming on and things like that, and it's like there's a lot of uncertainty. And when that happens, developers will sit on their land. They won't develop just yet because they need to have certainty with what they're doing too, because they're not operators. They're there to develop it
Hmm.
and then sell it. And they need to know they can get their pricing. And as cap rates expanded too, it became less advantageous for them to do that. Well, you're now seeing that pendulum swing a little bit the other way. And I wouldn't say it's all the way over. I would just say it's starting to swing the other way, but
Hmm.
to where you are seeing organic rent growth, which when that occurs, you know, these operators start making more money and the deals become more valuable, and then developers will get back in. And so it's that's just how that cycle works, right? And so as you're starting to see more and more people move into these areas, I still think we have probably another 18 months, at least in the state of Texas, which I know a lot of people aren't going to like hearing that because that literally pushes us into 2027.
Hmm.
Um, before you feel kind of like that engine is running a lot stronger. It's kind of like a train, right? Train doesn't just go, right?
Right.
It takes a while to get that thing going, and we're at that point where we're starting to going, and then once it gets going, it's going to really it'll take off a lot faster, and so you'll start seeing a lot more trades even this part of the year. I would tell you we've been made the bridesmaid on several deals this year, and it's with those institutional type buyers who are coming in. And the last two we lost to cash buyers.
Mm.
One of them was for 57 million, the other was for 85 million. And so there is money, institution leads that syndication, like you said, they kind of they're the tail wagging the dog, so to speak. And when they start coming in particular to that strong, where they have cash to put together and great solid assets that are in good locations, those just never go out of style. They don't. And they're looking to place capital right now, and they're pretty smart with their money as well. So
Yeah, I mean, typically they didn't come to that amount of money, whether it's a family office or whatever it is, by being foolish. But, that also begs the question, and we saw this with the hedge funds, buying up single families years ago and other things where anybody that's a smaller operator can look at it and say there's no way they're logistically making money, but yet they would just park their money because it was safer than other investment vehicles where they were losing. Is that what they're doing? Like these organizations that beat you out, or are these legitimate operators that just have the cash?
no, these are legitimate people, but I think part of their reason for doing it is uh, it could be financing, right? That they may feel that, hey, rates may be a little bit lower in a year or two or whatever, and we'll park the cash and we'll go get it again when we feel rates will be a little
Hmm.
bit more advantageous to do that. Um, or it could be, hey, we've just got this much cash right now. Inflation's still chewing through it each and every
Right.
day. It's way better for us to have it in this type of an asset that's going to keep up and maybe beat inflation.
Hmm.
So let's go ahead and put it into this illiquid asset to do that. And
That's a
so,
great point that most people probably don't comprehend the way they should, even though it's pretty simple. When you get to that point where you have cash sitting around, you can't just let it sit around. You literally can't.
no, because it decreases in value every day.
Right. And, everybody dreams of being to that point in their life. But I know back when I co-owned a lending company and, we raised money, hard money lenders, we raised money, we lend it out. And there was times where, you had money that was coming back and you're stressed out because we can't have cash sitting. Like it literally costs money to let money sit. And we're talking hundreds of thousands, if not millions of dollars. And most people that again might be listening to the show that are smaller operators, it's hard to comprehend that. But it is actually a problem to have
Sure.
cash.
Yeah. So I still sit on the board of a bank. So we started another bank about 3 years ago um, here locally. And so I would tell you, you have to understand it's every month people come back and pay loans.
Hmm.
And that's money coming back in that you have to find ways to put right back out because, like you said, if you're not growing, you're dying in that business. It literally, you can't just be sitting on cash, right? You have to have that money cycling. Money has to work. It has to flow, right? And if it doesn't, it dies. So um, it's a good way to look at it.
Yeah. Well, I'll get you the hardest question of the day,
Okay.
that I do to almost all my guests.
All right.
What is one question I should have asked you that I didn't?
Who? We have so many investors that also, and you could tell they're somewhat new investors too. They come up and say, "Oh my gosh, I can't wait. I want to do X, Y, and Z." They have so many things that they're looking to do with it. And I always tell them, before you go and, if you put together, say 50 or $100,000 that you're ready to put into a deal, I always tell them, look, there's always another deal. if you were to invest in anything, though, I would invest in yourself first, meaning get educated on this stuff, learn how to underwrite. There's a slew of YouTube videos out there that you can learn from people that are attractive to you to learn from. Before you go and put your hard-earned dollars to work, you got to understand what you're getting into because there's so many people that just don't understand what they're doing when they're investing. And so that would be the question I would say is, hey, what should an investor do when, they're first starting out or they're trying to do, and I just literally tell them, look, pause for a second. What do you know and what can you improve in your own knowledge before you go put, $100,000 to work because it's a lot of money, right? And you probably should know what you're investing in before you do that because you also have to understand that can go to zero. I mean, it can go to a lot, but it can go to zero too.
Hmm.
And so make sure you know what you're getting into before you do that.
Perfect advice. I love it. Well, Sam, thank you so much for your knowledge and your time. And it's always fun for me to talk to people that have been around for a while through the market cycles because we can definitely resonate and hopefully bring that across to the audience. So again, thank you.
Absolutely, Derek. Appreciate it, man. Thanks for having me on.
You bet. Everybody else, if you're a regular listener, thanks for being here. If you just found us, thanks for finding us. And go out there, help us spread the message of the generations of wealth. And we will see you on the next show. Have a good one.